Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman and Wakefield's #1 investment sales team in New York City.
Hi, I'm John Hageman, partner at the Knakal Group at Cushman and Wakefield. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, chairman of New York Investment Sales for Cushman, and we're here to talk about the stats in the first quarter of 2016. So Bob, we're here at the end of the first quarter, and in one of your recent Observer articles, you likened the market to a spaghetti western. What the heck does that mean?
Well, Hags, what I was referring to is that subgenre of movies made in the 1960s, made famous by Sergio Leone, and one of my favorites was the 1966 classic, The Good, the Bad, and the Ugly. And I think the investment sales market in New York City today is at times good, bad, and ugly. And it's been very, very challenging to figure out where the heck the market is because we're seeing each of those things almost every day.
So now that the numbers are in, tell us what some of the statistics are saying.
Well, I think it's important to just take a step back and look at where we've been. I mean, clearly 2014 and 2015 were the two best back-to-back investment sales years I've ever seen. We had a record number of buildings sell in 2014, the highest total ever in the city at 5,533. In 2015, dollar volume hit almost $75 billion, which was also an all-time record. So we came off these two unbelievable years, and we anticipated that the market was going to be changing as we came into 2016.
Why did you feel that way, Bob?
Well, if you look at 2015 and break the data down into quarterly statistics, you start to see in the third and fourth quarter some cracks appearing. The cap rates were inching up a little bit. Prices per foot were nudging down. We started to see some softness in the land market and the hotel market. And it looked as if we were going to be leaning towards a fairly significant correction in the market.
And so why do you think that happened?
Well, mainly I think that property values got way out ahead of where fundamentals should dictate they should be. It seemed like values kept going up at a much greater rate than fundamentals were getting better. So values just simply got too high, and I think that people started to resist these ever-increasing prices.
Bob, tell us what the numbers actually turned out to be in the first quarter.
If we look at the number of buildings sold, we see that in the first quarter there was 1,205 properties sold in the city. And if we annualize that, we're going to come up with a reduction of about 7% for the year. If we look at the dollar volume of sales, we see that we had about $14.1 billion in the first quarter of the year. Annualizing that gets us to about $56.4 billion, and that total would be down about 25% from the approximately $75 billion that we had last year. So we see that coming into the year, we anticipated that number of properties sold would be down by a higher percentage than the dollar volume. So far, it's been the reverse of that, but we think over the course of the year, those numbers will reverse.
As we've seen in the past, Manhattan's always a leading indicator for the rest of the market. So what's happened specifically south of 96th Street?
Unfortunately, Manhattan really took a hit in the first quarter. The number of properties sold and the dollar volume both dropped by very significant amounts. If we look at the number of properties sold in Manhattan, there were 178 sales in the first quarter. Annualizing that puts us on a pace to be down about 34% from last year's total. And the dollar volume was just over $9 billion, and annualizing that would put us on pace to be about 38% below where we were last year. So as Manhattan is the leading indicator, that doesn't bode well for volume throughout the rest of the year.
With all this being said, Bob, how do you view the next 3 quarters and the rest of the year playing out?
Hags, I think that our projections and forecast at the beginning of the year probably will hold. We projected that values, if we aggregate everything in the market, probably will be a little lower at the end of the year than they were at the beginning. But even with a 40% drop in the number of sales, will still be well above what the average year has been over the last 30 years. So it's making it more difficult than ever to figure out what the heck is going on in the market, but certainly it'll be an interesting end to the year. In summary, the New York City investment sales market in the first quarter of 2016 behaved as we expected. The number of properties sold was down about 7%, and the dollar volume of sales was down about 25% from last year's totals. While the trend has generally been downward for the marketplace, positive surprises are occurring frequently, making the market much more difficult to figure out.
Thank you for joining us today. Tune in next week for another episode of the Knakal News Network.